Hey everyone, I am absolutely thrilled to have you here for today's explainer. We are going to unpack one of the most fascinating financial paradoxes in the market right now. We're talking about Enpro Inc., trading under the ticker NPO. On the surface, this is a stock that just seems to completely defy gravity. I absolutely love these kinds of mysteries, because as we peel back the layers today, we're going to find a company that appears to be breaking literally all the traditional rules of finance, yet it just keeps rewarding its shareholders. So let's jump right in and start the investigation.
Okay, let's dive into this. 442%. Just let that massive number sink in for a second. That is Enpro's total return over the last 10 years. For anyone holding this stock, it has been an absolute rocket ship. To put that into perspective, you're looking at an average annual growth rate of over 18% a year. Now, if you look at this number in total isolation, you'd probably think, well, this company must be firing on all cylinders, right? They must be growing their bottom line at a record pace year after year.
But here's where the plot thickens. We have a seriously stark contrast. On one hand, the stock is still surging. The year-to-date return is a very healthy 33.7%, and the three-year return is a staggering 211%. Investors clearly absolutely love it. But on the other hand, the trailing 12-month net income, the actual accounting profit the company is reporting to the world, has plunged by over 44%. Think about that. How does a stock triple in 3 years while its net income practically gets cut in half? That right there is our central mystery.
That bizarre divergence really forces us to put on our detective hats. Because if the stock price is going up, but the net income is going down, well, logically that means the stock is getting way more expensive relative to what it earns. So we have to ask the obvious question here. Is NPO just wildly overpriced? Are investors buying into some massive bubble? Or is there something else going on entirely? Let's take a look at the actual valuation metrics to find out.
Real quick, just to ground ourselves before we reveal Enpro's numbers, the price-to-earnings, or PE ratio, is pretty much the most common valuation metric out there. It simply measures what the market is willing to pay today for $1 of a company's past earnings. Lower PE usually means it's cheaper. A sky-high PE means the market expects massive future growth, or, that the stock is just dangerously overvalued.
Brace yourselves for this one. Enpro's current PE ratio is an astronomical 149.71. That means investors are paying nearly $150 for every single dollar of accounting profit the company generated over the last year. On the surface, this looks incredibly dangerous. A PE of 150 is usually reserved for hyper-growth tech startups that are about to change the world, not an established industrial company.
And this brilliantly illustrates just how absurdly far things have stretched. Comparing the current valuations to Enpro's own 3-year historical averages is mind-blowing. The PE ratio is up an incredible 16,000% from its 3-year average of 0.92. Actually, wait, it's not just earnings either. The price-to-sales ratio is up 44% to 5.28, and the price-to-book ratio is up 36% to 3.90. Across the board, all the traditional metrics are just screaming that this stock is historically expensive.
Okay, so we know the stock is historically expensive, but let's shift gears and look under the hood at the underlying operations. We need to examine where the company's accounting profitability is fundamentally breaking down. The income is dropping, for sure, and as we analyze the next set of clues, you're going to see that this isn't just some top-line revenue issue. It's a fundamental deterioration in their traditional accounting returns.
The breakdown here tells a very cohesive and honestly, a seemingly terrifying story. Enpro's return on assets, basically how efficiently they use what they own to generate profit, has dropped 57% from its 3-year average, down to 1.57. Return on equity, which measures profitability against shareholder investment, has plummeted 60% down to 2.62. And their net profit margin? Down nearly 59% to 6.82%. So essentially, they are making far less paper profit on every single dollar they manage.
And just to drive the point home, you might be wondering, is this just a short-term blip caused by one bad quarter? Well, nope. The 5-year compound annual growth rate for net income is negative 25.58%. Over 3 years, it's negative 41.74%, and over the trailing 12 months, it's negative 44.44%. The accounting income isn't just shrinking, it has literally been shrinking at an accelerating rate for the last 5 years.
Let's just take a deep breath here. We are faced with a massive contradiction. We've got accelerating declines in net income, collapsing profit margins, and a PE ratio of almost 150. So here is the ultimate mystery question. If income is shrinking so drastically and valuations are sky high, Why on earth is the stock up 33% this year and 211% over the last 3 years?
All right, this is where the story gets incredibly fascinating. It is time for the twist. We are about to uncover the hidden metric that is not only keeping Enpro afloat, but actually propelling it higher. This is the secret that the absolute smartest investors are looking at, while everyone else is out there panicking over that 150 PE ratio.
The secret lies right here: free cash flow. Unlike net income, which, is subject to all sorts of accounting rules, non-cash depreciation, and paper write-offs, free cash flow is the cold, hard cash a company actually deposits in the bank at the end of the day. It's the money left over after paying for operations and capital expenditures. In finance, there's a great saying: profit is an opinion, but cash is a fact. And Enpro's facts tell a vastly different story.
Let's rapidly run through these free cash flow numbers, because they completely wash away the negative income data we were just looking at. Trailing 12-month growth, up nearly 18%. The 3-year average, a rock-solid 18.1%. And the 5-year growth rate is an incredible 35.8%. All of this culminates in a massive $153.1 million of actual, undeniable free cash generated in the last 12 months.
Now, what's really interesting here is the sheer magnitude of this disconnect. It's just staggering. On one side, you have the accounting net income for the trailing 12 months sitting at a measly $40.5 million. But on the other hand, the actual cash generated was $153.1 million. That is a $112.6 million difference between the paper profit reported to the IRS and the actual cash printed. The market isn't buying Enpro for its accounting net income, guys. It's buying Enpro because it is an absolute cash-generating machine.
And because of this incredibly robust cash generation, we actually start to see glimmers of true operational efficiency underneath all that accounting noise. Enpro's return on invested capital, which is a really critical metric for how well management deploys capital, currently sits at 4.86%. Now, while that number might look a little modest on its own, it is actually up over 20% compared to its 3-year average. So while paper margins are dropping, the core efficiency of their capital deployment is actually improving.
And you better believe management knows exactly what to do with all that cash. They reward their shareholders. Enpro currently pays a dividend yield of 0.45%, and they have confidently increased this dividend for 11 consecutive years. But here is the absolute best part. Because their free cash flow is so enormous, paying this dividend consumes only a tiny 17.20% of their free cash flow. That dividend is incredibly secure and has massive room to just keep growing.
So we really have two competing realities here. A horrifying accounting picture with a 150 PE ratio versus a beautiful cash flow picture showing a highly secure and growing business. We need to gather all our clues together to determine the actual fair value of Enpro's shares. Let's get to the final verdict.
To do that, we rely on the ultimate financial lie detector test, the discounted cash flow model, or DCF. This model is great because it completely ignores the noisy accounting metrics like the PE ratio. Instead, it looks exclusively at how much cash the business will generate in the future and discounts it back to today's dollars to find the intrinsic, true value of the stock.
So the crucial point is, when we strip away the accounting illusions and run a DCF model based purely on Enpro's exceptional free cash flow, the fair value price of the stock sits at $311.66. Compare that to the current stock price of $285.94. Suddenly, the stock doesn't look expensive at all, does it? In fact, based on cash flow, it is still fundamentally undervalued.
That difference between the current price and the fair value actually gives us an 8.25% margin of safety. The mystery is solved. Despite the terrifying 149 PE ratio that would send a novice investor running for the hills, the immense cash generation of this company provides a built-in cushion for those who know how to look past the surface-level metrics.
Which leaves us with this final thought to ponder. When you are analyzing a stock, what numbers are you really trusting? Enpro perfectly demonstrates that if you only look at traditional earnings, you might completely miss out on a phenomenal 442% return. So ask yourself, are you valuing your investments on accounting illusions or cold, hard cash? Thank you so much for joining me for this explainer. I really hope this changes how you look at the market. See you next time.